Hey everyone, thanks for coming. We waited now for 7 minutes, so I hope that's enough. If anyone else is coming, we can reopen the door. I already realized the air is quite thick, so I hope you don't fall asleep. Or if you fall asleep, it's because of the air, not of my presentation. My topic today will be how to exit your SaaS with a smile. I did a previous talk with a similar topic, but because of the memes, I gave it a twist with the smile. We are talking about exiting a SaaS company, and I'm Dirk. I work at saas.group. We are a serial acquirer of SaaS companies. So over the last couple of years, we acquired 20 small SaaS companies. So we're active in the microcap space, and that's why I know a bit about SaaS M&A, but on the other side of the table, so not from a founder perspective, but from an acquirer perspective. How to exit your SaaS with a smile. What am I going to talk about to you today? First point, when to exit. So when is the right time, when you should pursue an exit. Then also the to whom. So what are potential buyer profiles? What are the relevant buyers for you and your business? Then the third point, at what price? I think it's a heavily debated topic, SaaS valuations. What are you going to get for your business? I guess it's interesting for everyone. And then the last point would be about the how. So how do you approach the exit when it becomes relevant to you, and what are things to consider in this regard? So let's start with the first point, the when. So would you say now is a good time to sell your SaaS business? Who says yes? You're biased. You're biased. Who says no? Okay, good. So quite a few say no. Nobody except Tim says yes. So it's more people for no, unfortunately. So when is the right time? I mean, if you think about the typical SaaS curve over time, so at the beginning it starts very slow, you're trying to figure out product market fit, you're not maybe growing that much, and then at some point you might find product market fit, it starts to pick up. So you see it here. This is like pre-product market fit, and then you figured out product market fit. At this point it starts to grow faster, and at some point it might start to slowly flatten out. And this time can be years, it can be decades, it can be months. So this is driven by so many factors, your own capabilities, market environment, market size, market growth, whatever. And so we see companies reaching that point at like 2 million ARR or maybe 2 billion ARR, so it really depends. And if you look at this growth curve now, would you say like this is a good point to sell? Probably not, right? This? Not really, right? So if you're only looking to maximize exit value, I brought this chart, which makes it a bit more visible when you want to maximize enterprise value for your business. So you wouldn't sell at like the early stages when it's super small, unless you really have to. I mean, we see fire sales, we see companies fail and you want to have a quick exit, but it's not like the super great financial outcome, most likely. And I would say from my perspective, from SaaS Group perspective, most conversations I personally have, they are at around here. Okay, so if the business has started flattening out or so, or if it's already flatlining. So we're not growing, we're not buying high growth companies, that's why. So it's just our target group. And so yeah, you can see it in the chart. If you want to maximize exit value, then you have to pick a point along this growth curve. But the problem here is it's a psychological thing, because if you're in that phase, like everything is going well, okay, so you might always think like, if it's going well, why sell? I could wait for next year, I could wait another 5 years, so maybe it continues and you never know what's coming next. So hardly any founder manages to sell at this point. And I also want to encourage you in general to also consider different exit reasons. And I interviewed a few founders that have sold their business to us, what their main driver was, apart from like the financial aspect of that exit. And you see someone mentions health reasons, so he had some serious health issues, and that's why he considered an exit. Antoine from Dashes, he was expecting a third child and wanted to have a better work-life balance. Same for Peter from MyWorks. And Joseph from UserSnap, they've been running for UserSnap for 10 years. And so for him, it just felt right. So it was more of a gut feeling to finally take some chips off the table. So my key takeaway from okay, when is the right time to sell? Of course, on the one hand, you want to have an attractive exit from a financial perspective, but also want to consider other reasons as potential exit reasons. So 3 points here. I would always encourage you to explore opportunities along the way, and not just, I'm also getting email responses like piss off, like fuck you, I'm not selling, I'm not talking to you guys. It's fine, I can live with it, it's part of my job, but I encourage you to just reply nicely saying sorry, not relevant, and just keep that contact in your Rolodex. Or if it's a more serious conversation, just entertain these conversations, but not waste too much time, because along the way you will learn so much about buyer profiles, how to approach these conversations, questions they ask, etc. And it also might help you in later stages if you're really preparing for an exit. Then second point, give sufficient weight to personal reasons. So I literally had conversations with founders that started crying during our calls because they were so stressed out. Like, this is too late, I would say, personally. So I think your mental health is worth more than a higher multiplier for your business, I would say. And yeah, third point, don't try to time the market, because it's impossible. You never know. Is there like another war starting? Is like the economy collapsing? Is it like skyrocketing? You just don't know. So that's why you should sometimes give more weight to also personal reasons and not try to chase a carrot for years, even though, you might be super stressed. Second point, what are potential buyer profiles? And I know Tim is really looking forward to this slide, because I thought it's a good reference to just take Tinder profiles of different buyer types to describe it. So, the buyer landscape, there are thousands of different buyers. So sometimes industry agnostic, like we are, sometimes verticalized, sometimes they only buy larger businesses, sometimes smaller. But if you put them together in a couple of groups, I would say you can identify 3. And we are starting on the right. So this is Mark Benio from Salesforce, and he's representing the strategic acquirers. They have deep pockets. They offer premium valuations, so sometimes crazy, and not backed by any fundamentals. So sometimes they pay 50x. You also see 100x. But I would say now it's more conservative, but still premium valuations. But they don't really care about anything else than your IP, your moat, and your cutting-edge technology. So you can say we have a great culture internally. They don't care much. You can say I have strong net dollar retention. They wouldn't care much. Salesforce, how much revenue are they doing? They don't care about what your 15 million ARR business is doing. They really care about expanding their own product line, entering new markets. So they usually try to just increase their market dominance, and it needs to be tech IP related. Then in the middle, I would say you have kind of a mix. So I would group them into large PE funds. We also have founders of bigger SaaS companies here. So you might also have a business that serves as a platform where you put certain add-on acquisitions around, but it can also be relevant for smaller SaaS businesses to serve as an add-on acquisition. So they start building a platform, and then starting to consolidate the market, buying more and more smaller businesses on top, or just trying to seek synergies to complement this platform with certain features and products. And for them, I mean, PE already says they want to generate a return, so they would still look at your numbers, but they can price in certain synergies, and so they pay slightly above market because they can price in these synergies. And yeah, as you can see in the interests, they're usually looking for a strong customer base. They want to have complementary products that serve their platform play, and they want to have established organizations. So if you look at small SaaS companies like WeBuyit, it's usually not an established organization with hierarchies and proper operations and everything. So it's still more of an indie hacker type of thing, and that's not what large PEs want to deal with. So they want to have a working organization where you don't need to be as hands-on. And yeah, then on the right, you have the small PE funds, or like we define ourselves more as a SaaS aggregator. They just have a different approach. So we are a long-term partner. It also says on the profile. So we want to own businesses forever. We're not going to flip them, and so we put a lot of value on like preserving the legacy, taking care of the team, taking care of the product. But on the other hand, we are not offering the same premium valuation. So it just comes with some trade-offs. And if you now think, well, okay, I just talked to these guys, I think it's super difficult. So if you just focus on strategic acquirers, it's a bit like gambling, basically. Because if you're not on the priority list of any strategic acquirer at this point, or it's important for any VP or any CEO of a big scale-up or big enterprise, you will not get a deal done. So it's impossible. And if you can do something, then it's to get in touch with these people and just land on their radar and hope for the best. But still, especially in our microcap space, these strategic acquisitions are super rare. So sometimes we lose deals to strategic acquirers, but it happens like once a year maybe. So yeah, the takeaway here is you should know the relevant buyers. So hopefully only spend time with the acquirers that are relevant to you and not with anyone else. And then you also need to understand their intentions. So if it's a strategic acquirer, don't pitch maybe your NDR and whatever. So put more focus on your IP, your moat, your customer list, whatever they are looking for. And on the other hand, if you're talking to more financially oriented acquirers, then you need to pitch like your strong fundamentals, like the strong KPIs, like your growth, maybe also your bottom line, your profit margin. But you don't need to talk to me and pitch your strong IP if it's not reflected in commercial success, because we can't value that. At what price? The valuation topic, a very important one. So where would you look if you wanted to know what SaaS companies are trading for these days? Where would you look first? I will tell him that. Any suggestions? I guess most of the SaaS founders would look at public SaaS multiples. So, I mean, there are a lot of public SaaS companies. Everyone can see that data. There are lots of platforms that are providing this data, and so you can access it quite easily. And so it would be the first step to just check what public SaaS companies are trading for. And this is a slide I took from Altimeter. It's from Clouded Judgment newsletter. And they are providing a weekly overview of SaaS valuations in the public market and also KPI benchmarks. And you can see that if your company is not growing that much, as a public company, it's more like 4x next 12 months revenue. And if it's growing a bit stronger, then it goes towards like 10x. So this is kind of the baseline in the public market. If you go one layer deeper, you might look into industry-specific reports or benchmark reports of bigger PE firms. So for example, I'm often looking at software equity research. They are doing a lot of research in the private SaaS M&A market, and they also show some multiples. This is not next 12 months. This is trailing 12 months. So backward looking, not forward looking. And you can already compare it. So companies these days are trading for a median of 4x revenue, which means it's slightly below the public market if you compare the two medians. So rough numbers, public SaaS 6x and private SaaS 4x. But as a SaaS founder, like you often tend to compare yourself with others. So you're saying, oh, my competitor got acquired for 20x by Microsoft, or I have a friend who exited his business for 8x, so my business might also be worth 8x. And I personally encourage you to don't compare yourself with others, but maybe spend more time understanding the intrinsic value of your own business. And I just want to give you some rule of thumbs here. So if you look at like SaaS valuations, if you Google it, you might stumble across a sentence which says a company's intrinsic value is the present value of future cash flows. And what it means is that an acquirer will pay you for the cash flow they might potentially earn over the next couple of years. So buyers, I also posted it today on LinkedIn, it's not charity, okay? So buyers also want to generate a positive ROI. So they pay you a price where they are confident that they can earn it back and more over the next couple of years. And you really need to understand it. So if you look at your revenue forecast, cash flow forecast, this needs to be reflected. And this is where you can see the value of your business and not so much by comparing yourself to others. And I will give you another rule of thumb. It's a very broad benchmark, but usually private equity buyers, like smaller and larger ones, want to 3x their invested capital over 5 years. And that's basically the story you need to graft if you're talking to acquirers. So if they buy your business for 10 million today, they want to get out 30 million in 5 years. And it can be, if you're not producing any cash flow, by just exiting your business in 5 years for more money. Or it can be to earn the cash flow over the next couple of years, or a combination of both. So earning cash flow along the way and selling your business for more in 5 years. Sometimes the holding period is longer, 10 years, 7 years, but the calculation more or less stays the same. I also posted this one on LinkedIn today. That's an email I got in April last year. So what I want to comment here is, if you're not pressured to sell, if you're not looking to sell, if you're growing fast, and the buyer comes around and you just want to politely say, no, this is the right answer. So if they're really interested and want to put 35x on the table, well, that's great. So if this is your, how you call it, fuck you number, then this is it. But if you are moving towards an exit, this is what a buyer would mark in the CRM as like, don't talk to them anymore. And so it will bring you further away from an exit rather than closer, and it doesn't bring you any leverage in conversations. So as long as you're not pressured to sell, this is the right answer. But if you want to entertain serious M&A conversations and you're coming up with a 35x, then you really need to have strong arguments how a buyer can generate a positive ROI. Yes?
And that was a nice response? I feel like this guy's crazy.
It depends. I would say it's at least clear, right? So I don't need to dig deeper and ask him like, hey, maybe there's still an opportunity. I think this is pretty clear.
You should put up the not nice ones. That would be a lot.
Yeah. Well, there are a few not nice ones, but I think like this is okay, understood, not worth investigating, not worth talking. So let's just keep in touch. And in the meantime, we had a follow-up, and now he's asking for 40x. So it increased in the meantime, which is fine. I mean, the company is growing fast, and they're now looking more to raise money than to exit, and we might not be the right buyer. So as I said, it's fine. For me, it's still polite. Valuation drivers. Revenue growth, still number one. As I said, SaaS Group, we are more looking for moderately growing companies. But if you are growing 50, 60, 70%, maybe even 40 in today's market environment, this is like defined as high growth. And someone might put a nice price tag on it. Second group of factors is quality of revenue. So do you have a lot of service revenue? Is it revenue recurring? Is it not recurring? How does your churn look like? So on Monday, we had another founder meeting where we had a sell-side advisor, and they were saying churn retention is one of the top conversation topics in M&A talks these days. So people really take a look at your churn profile, and if you have like 5-10% monthly revenue churn, it's super bad, and you cannot expect like a super great multiple. And then also client concentration. And I also had a debate with a founder the other day who was saying, okay, we have a client who's willing to pay 1 million. It would be basically half our ARR right now. Should I accept it, or is there any consideration in terms of SaaS valuation? I mean, of course, you want to onboard a client that's paying you 1 million per year. So there's no argument against it, but you also need to consider that it will not be considered as not a risk. So people might still, like buyers might still consider it as a risk that this customer churns, and so you cannot maybe apply a typical SaaS multiple on the total revenue, but rather accept the discount. Third point, operational efficiency. I mean, it's pretty clear, gross margin, EBITDA margin profile, rule of 40, and also your sales and marketing efficiency. So things like CAC ratio, magic numbers. So are you efficiently acquiring new customers? What are the channels? Are they all working profitably? What's your CAC payback period and everything like that? So we also at SaaS Group, we really dig deeper into these topics and try to find out. So, well, you're growing, okay, but how much money do you spend on growth? Is it sustainable? How does the market develop? And how were your numbers historically? And the last point, and this is very much dependent on the buyer profile, how they value qualitative factors. So this is what I said earlier about the strategic ones. IP might be super important for them, not so much for us. Brand might be important to them, not so much for us. And then it's also market attractiveness, or maybe your customers. So if there's a strategic acquirer who struggles to sign Salesforce as a customer, you sign Salesforce as a customer, they buy you, and so they get like a foot in the door. And for them, it might be worth millions, but probably not for SaaS Group. So these are the valuation factors. And as a key takeaway, so really try to understand the fundamentals of your SaaS business, what's driving the valuation, and then also how it correlates with the buyer profiles and what you need to pitch to them. And it should be reflected in their willingness to pay and how they can generate a positive ROI. Last point, how to prepare for an exit. And as I said, we are mainly dealing with very small companies. And in these small companies, it usually looks a bit like this. Sometimes better, sometimes worse. But a lot of them really don't have their stuff together. So you ask for standard KPIs, and they say, okay, give me 2 weeks. I can assemble something. Shouldn't be the answer. So the answer should be, okay, I send it to you after the call, and then you just provide access, and that's it. Maybe in between you sign an NDA, but you should have this stuff ready, and also answers to questions if you're seriously entertaining an exit. Some more considerations here. Financial and metrics, I already said it, so you should have this stuff ready. We also learned yesterday that smaller companies often don't even file their taxes and everything, so I mean, this will pop up in an exit process 100%, and a buyer may just bail out because of it. Operational efficiency, so if the business, for example, is heavily dependent on the founder, that's a bad sign. So if you're looking to have a short transition period of just 3 months, but you're still like coding and building the product, then a buyer might not be that interested because it's hard to replace you and it will be difficult to integrate the business. Tech and product, I mean, technical debt is a topic. It was also the reason why we, for example, canceled one process. Also, if stuff is not properly documented, so also a potential deal breaker here. Legal and compliance. I know it's a boring topic. I think something that pops up in our deals every now and then is that you don't have IP assignment agreements with your employees. So they make like company inventions, but it basically belongs to them. And it's weird if you come to them with an additional contract in the M&A process and ask them to assign their created IP to your business retroactively. So make sure you have this in your employment agreements if you haven't already. And yeah, last point, also why a lot of conversations fail is because you don't have shareholder alignment. So founders coming to us, talking to us, saying, hey, we're interested, offer is great, but we just need to convince shareholders. And then you have like a super fragmented cap table with like a few small angels, and all of a sudden there's one that's basically blocking the deal, or is just tied in with like personal money and don't want to lose it. And then you have a serious problem. I mean, there are drag-along, tag-along rights, but at the end of the day, you don't want to fuck anyone up in that process, so it still causes some issues. So, yeah, to wrap it up here, keep your business tidy right from the start. So just make sure you're not creating a mess over time that just gets worse. Just because you're not entertaining exit conversations, it's still important because, like, if Microsoft knocks on your door tomorrow and they want to see stuff and you cannot provide it, then you may not get your great exit and missed out on an opportunity. And also the last point is get external help if needed. So if you say, well, so many topics, I still need to run my business, it's distracting me, then just get help. I think we also have some sell-side advisors here, like FE International. They may take a cut of your exit value, so I think it's like between 3 and 5% or something, but sometimes it can just be worth it in relation to the value they are providing and the help they can provide. So yeah, to just sum it up before I'm happy to answer any questions. When to exit, so just explore these conversations along the way if you're not pressured to sell, but don't try to time the market and maybe also take other reasons into consideration. Then to whom? You should know relevant buyers, maybe even build up a Rolodex of relevant buyers over time so you can just send an email, merge to them once it becomes more relevant and you already have a foot in the door and can start conversations. And you can already start building those relationships today. So for us, for example, it takes between 2 and 4 years from I talked to the founder to we signed a deal. So it really takes time for strategic acquirers even more. So I read someday, I mean, the deal didn't close, but Figma was talking for like 5 to 10 years to Adobe before they were entertaining or getting deeper into M&A conversations. Then at what price? So understand what's driving your company's valuation and don't look too much left and right what others are getting and what the public market is saying and everything. And then the how, just, keep your business tidy, keep everything in order, and get an advisor on board if you need help with these topics. And this was it from my end. I hope it was helpful, and now happy to answer relevant questions. Yes. Here's a mic.
Thanks for the presentation. You did not talk about the cash in itself, the company's cash position. How do you approach it as a buyer? How do you look at the company's cash position? Do you look at how many months of cash they have in front of them, or how do you approach that?
Yeah, so we also had this conversation yesterday. Sometimes buyers may require you to keep a certain amount of cash in the business when it gets sold. Sometimes you just take it out before you're selling it, but usually you pay dollar on dollar for it as a buyer.
And what I meant also is, do you can it be a leverage for the buyer? I mean, if let's say the company has only 6 months of cash or even 12 months, yeah. I sometimes hear that buyers can play on that also to make things a bit last and at some point have the best price.
Okay, yeah. Okay, that was what you're referring to. So we at SaaS Group, we primarily focus on profitable businesses. So it's not necessarily our issue in our conversations, but it's definitely a topic, especially when you're a VC-funded company, you're struggling to raise a follow-on round and you're running out of cash. So I think you should definitely have a plan B. And I mean, worst case, and I've seen it 1 or 2 times, that they just let you run into bankruptcy and then they buy you for cheap out of bankruptcy. This is something you want to avoid. So if your runway is kind of limited, you should make sure that you have a backup plan, that you're not losing leverage. Yes.
How common are earn-out scenarios or more complex deal structures in for example, the type of companies you acquire?
It's very common, and so maybe I go back to the first slide. Where was it? Here. So for us, usually we take over the founders and the whole team, and everything just stays as is. But of course, as a founder, you don't want to become an employee of a bigger organization. Just get a great, nice title like VP of X at SaaS Group. And so we usually offer earnouts to keep them incentivized from an entrepreneurial perspective. Does anyone not know what an earnout is? Okay, so it's basically, there are different kind of deal components. The easiest way would be, we value your business and we give you everything in cash. So we sign the deal and we just wire it to your personal bank account. But sometimes you have a certain transition period, so you're selling the business, but you make sure that there's a handover period and you're staying. Yeah, a bit like a vesting model. That means you define certain milestones, and depending on these milestones, you're getting an additional exit consideration. And for us, I think on average, it's around 20 to 30% of the deal. So you get 80% in cash, 70, 80%, and the rest is tied to an earnout. But we at SaaS Group, we have a high flexibility, so you can decide what you personally want, but other buyers might just force you into their own model. So I didn't really cover deal structure elements, but maybe just to mention a few. I mean, cash, I just said, you just get it wired to your bank account once the deal closed. Then there's earnout, so it's performance-based or milestone-based after the exit, so you get cash, and then potentially if you hit those milestones, you get an additional consideration. Then there's seller financing. That means you're basically giving a loan to the buyer. It's when a buyer doesn't have the budget to pay the full consideration at closing. You can say, okay, I don't need the money anyway, I can wait for it for 3 years. And so you basically lend it to them for 3 years and earn interest on it, like 5 to 10% these days, I think. It's also very common, especially in the microcap space, because many buyers don't have the budget to put 10 million on the table. Then another one could be stock swap. So you're converting your shares into the buyer's shares. These are like the common structures.
And can an earnout be a tool to leverage for the seller, like in the spirit of I'm selling you today, but at a higher price because I'm staying?
Yeah, it's usually as a tool being used to bridge valuation gaps. So if you show me a forecast that's going like this, but your previous traction was like this, then I would hardly question it. But if you're confident enough, I can say, okay, we apply this one, and if you achieve it, you're getting more money. So it's we're not using it as a tool like to force founders into it. But if there are certain gaps, you can bridge it with an earnout, so you can have some upside. And what I wanted to show you here, so if you're considering a sale here, you might opt for an earnout, because if you're confident that the business can continue to grow, then you just get more upside. If you're here, I don't know if it makes sense to have an earnout necessarily.
Yeah, just curious. You say 20 companies bought so far for the group, yeah. And how long, on average, do the founders stay after you sign the contract?
Yeah, it's a good question. So first, I can tell you about the range. I think the fastest was 3 to 6 month transition period, and now we have, I think, 1 or 2 founders that have been with us for over 2 years. So with us, they can decide. Some enjoy being part of another group or a bigger group, and the support we are providing, and some just want to move on and start something new. On average, I would say it's a year. So less, I would say, is difficult. It can work if it's a super small setup, like team of 5 people or something, and everything is well documented. But if you have a certain complexity, I think a year is a good time frame. Any more questions? Yeah.
In terms of regions where you're looking for startups, what is the SaaS group?
Yeah, we have a German DNA, so all of the 3 founders are German, and that's why it has a German or European DNA, and that's where our home turf is, so to say. But the regions where we're actively acquiring companies are North America and Europe. So we acquired US companies, Canadian companies, and also Europe and France, Germany, Austria. What we're not touching so far is Africa, Asia, or in general emerging markets.
And you have a certain thesis on an industry or something?
We are industry agnostic. So what I said earlier is that many acquirers, they focus on a certain vertical because they are looking to build a platform and then just sell that platform 5 years or 7 years from now. And our approach is to keep acquiring more and more companies and become like a big SaaS family. And our focus is more on horizontal product-led companies. It's because this is where our expertise is. So we have a lot of expertise in marketing, like PPC, SEO, and that's what's driving growth of these companies. And so we have kind of a different approach to many other acquirers. I think there was also a question. You will get it.
So do you have a fund, or like are you raising capital on a per deal basis?
Nothing of these two. So it's a private company. It has been funded by the founders at the beginning. So the first acquisitions were out of their pocket money, basically. And then we started using a combination of existing cash flow and debt. So it's a bit like a snowball that is getting bigger and bigger.
Okay.
So yeah, and that's what I was saying. It's built as an evergreen model. So if it would be a fund model, then LPs might be asking for a return at some point, and this way we have really like patience and could basically continue to do this for the next 20 years.
Thanks.
so you can then give it to your neighbor then
Okay.
after you.
Well, mine's a follow-up question actually. How seller finance? I hadn't heard of that before. So how common is that, and how much leverage does that give the seller on potential valuation or negotiation, because they can offer essentially a sale price that's going to be cheaper for the buyer?
Yeah, so I mean, what I was just saying, we're using a mix of debt and cash flow, and so we need to use that debt and pay an interest rate on it. And so if we can delay it or we need less debt, it of course becomes cheaper for us, and that's where we can top up basically the enterprise value for a company we consider acquiring. So, I mean, sometimes founders are totally against it. They say, well, there's a risk I never get the money. Maybe SaaS Group goes into bankruptcy, and then I'm lost, and I lost some value here. But if you have enough confidence and you say, I'm not planning to buy a Ferrari, big house, whatever, then you can like earn an attractive interest rate on it. So usually more than you would earn on your bank account. So it's, I would say in the microcap space, it's quite common. We also use it as a tool sometimes. I think it's even more common in very small deals, like you would say on acquire.com or Flippa deals, where you buy like a private person buys like a 50K ARR company, then you can solve it through seller financing, because you're just using the cash flow of the business to pay out the seller. Does it answer?
Bigger deals? How common is it in bigger deals?
It's a good question. I don't know how it is in large cap deals, to be honest. If also like bigger PE firms are using it. In our space, I would say it's common, but I would say if someone is offering you like 80% seller financing, I would say it's a red flag. So it should be like maybe 10%, maybe 20%, maybe also 30%. But if it goes beyond that, I don't know. Like for me, it would be a red flag, because that means there are some serious risks for you to really leave half of your exit value on the table.
Yeah, how long does it take in average, like the full process, and what is the typical due diligence for you for the SaaS Group?
You mean exit prices?
Yeah. No, the process, like between the first discussions and okay, let's have a deal.
Yeah, so as I said, it can take between 2 and 4 years. So that's my personal impression. But this is like, I sent you an email, you say I'm not interested, but happy to hear your offering, then we have a chat. And then it takes time until this like exit plan arrives maybe. So this can just take time, but I'm not saying you're serious about an exit and then it takes 2 years. So if you come to me and say, okay, I'm now looking to sell, let's go, then for us it just takes a few weeks. So usually I would say 6 to 8 weeks from you get an initial offer from us, we agree on terms, and then commence with the due diligence. I think that's like 6 to 8 weeks. But if you're selling to a strategic acquirer, which is usually like a big tanker and everything is a bit slower, and they are like M&A is maybe not their bread and butter, so they're not used to it, then it can also take 6 months or even a year or even longer. So it depends on the size of the business and also the buyer profile. I would say we are quite fast compared to the market.
To react on what you just said, we often hear that a company is not sold and that it's being bought instead.
Yeah.
So from what you see, like, is it mostly founders trying to sell, or is it mostly buyers approaching them and then they ultimately sell?
Yeah, I know that saying that companies are being bought, not sold. I mean, if you don't have, it's always a matter of supply and demand. So if a buyer really wants to buy you and you have no pressure to sell, well, then they probably need to come up with a super attractive offer. Otherwise, you probably wouldn't pull the trigger. So it's true. I mean, in our space, to be honest, there are not that many buyers that pay significantly more. So in our microcap space, I'm talking about companies below 10 million ARR or even below 5, I would say. There are just small PE funds or other SaaS aggregators. And unless they have a more optimistic hypothesis with your business, I think their valuation model is pretty much the same. But if you have strategic acquirers and they want to acquire you, then yeah, if you have no pressure to sell and they want to have you, then they might want to put it on the table. What I also read, I think there was an article from Jason Lemkin on that topic, because he already went through multiple M&A deals from a founder perspective or investor perspective. And he said, if you're turning down an offer from a strategic, you really need to mean it, because next year things may have changed and they don't come back. So, I mean, to take the Microsoft example again, so if they're knocking on your door and they want to buy you today, and you say, okay, 30x, and they say 25, and you're saying no, 30, then they may say, okay, then we buy another company for 25, and they may not come back. So you may have lost a chance to sell to Microsoft. With us, it's a bit different. So sometimes you just reconnect, and maybe valuation expectations have come closer together, and we can find a deal where it was not possible like a year ago. But with strategic acquirers, if you give them a no, or if you want to play it hard, you may lose out on a big opportunity.
Yeah, because you've got a portfolio already of quite a few companies, and you've got experience in different like specific markets, and also specific types of companies that you purchased. And are you looking for any company really, or are you looking for companies that where you find bridges, potential bridges that you can build?
Yeah, so we just started this year with strategic add-ons. So we're also now running more strategic M&A projects where we look how we can puzzle together like small platforms within saas.group or build sub-portfolios in a certain space. So for example, we already own a few SEO tools, so it might make sense to look for other SEO tools or at least products that have a large overlap in terms of customer base. So that's what we just started. But apart from that, we're still quite opportunistic when it comes to the segments where we acquire companies. So you now see productivity tools, you see HR tools, you see marketing tools, and we're still quite open. I would say generally, what we don't like is what I also mentioned in the valuation drivers, high churn companies. So if you have more like a B2C type of software business with like 10% plus churn, because we've also seen companies that serve influencers on Instagram or something. So you might think you will become the next influencer, and then 2 months in, you're noticing, okay, you can't keep the cadence or it doesn't pick up, and then you just churn. So these kind of tools are usually not for us, because in general, like all kinds of buyers, I guess, are preferring sticky products where you have good retention dynamics. But this can be in multiple segments. Yes. Can you give it?
So this is just a question more about your strategic thinking of the market, which is that you were talking about valuations and what buyers would look for, and profitability being one of them, but not necessarily the most important. Do you think in the world of AI being deployed by so many companies to reduce costs, so essentially human costs are expensive, whereas even if AI is expensive, it's nowhere near as expensive as humans. Do you think, or have you considered, that valuations are going to be significantly affected by how reliant companies are on people versus processes and systems? Or put it a different way, is the old-fashioned B2B software version that we're all used to, that informed all of what you're saying right now, is kind of going out of date, and an AI-driven valuation model might take over?
So I think it might definitely influence how we look at companies in the future in different ways. So one other aspect, which might rather decrease the valuation, is that I've seen multiple companies that are using expensive third-party providers to integrate them into their products. and so their gross margin is like down to maybe 60%, sometimes 65. So maybe that could be a new reality, that you're using expensive third-party providers, or you're training your own models, which is resource intensive. So we may need to get used to lower gross margins. Maybe there are other people that are stating like companies are becoming more profitable, more effective. But I also recently read the report from Iconic, where it says like over the last, let's say 10 years, ARR per FTE has been going up. But funnily enough, OPEX per FTE was also increasing. So it's basically you spend the money elsewhere. And so, yeah, I think like not all of a sudden companies will turn to 20% EBITDA margin just because they integrate AI. So I think they rather want to spend to maybe grow faster. And so it will not become less profitable, but rather maybe grow faster. And I think currently everyone seems to be struggling with growth. So now it might not be visible, but maybe if you're going into different market environments, we might see that the growth benchmarks might change and not necessarily the profit benchmarks. So that's my personal take.
So you're not afraid of the one person billion-dollar company model?
Not really. Not yet. So I first want to see one example. I mean, what I've already seen is like 5 million one-person businesses. I also saw, I think one was like 14 million one-person business. But this is like 1 in like 10,000. And I don't think it's possible because, I mean, apart from like being super efficient, you cannot replace yourself talking to customers with just people interacting with an AI. That's my personal thesis on this.
Thank you. There is something I cannot get about SaaS Group strategy, because you said in some way you're looking for companies that already balanced, responsible, and everything are going pretty well. Acquisition channels are fine, etc. So, but if you buy them, you have no room for improvement in this case. Expecting that you're looking for you exploiting your knowledge, mutual knowledge on, I don't know, operations, processes, and things like that.
Yeah, so from my own perspective, they are not fully optimized, these businesses.
No, never, of course. But
to also show you this picture again, wait.
My question is, are you working on growth or costs, basically?
It depends on the company profile. So as I said, we have 20 companies right now, and you have, for example, companies in the CRM market, super red ocean, like lots of competition. Companies might be older, like 20 years old, 15 years old. So they are at the end of that S-curve. And I mean, if you would be bold and you have a strong hypothesis, you could say, okay, I bring this back to 30% growth. But usually in this case, you might be a bit more conservative and rather focus on reducing inefficiencies and maybe become more profitable. And on the other hand of the spectrum, you have high growth companies growing 50, 60, 70%. Then, of course, you wouldn't reduce resources spent on sales and marketing and try to make this super profitable, but rather try to maintain that growth path. And so we have multiple, let's say, buckets within SaaS Group where we put certain companies, whether it's growth continuation or profit continuation, and models in between. And it's not that we just have one playbook and we just apply it to all of the targets. It's really kind of tailor-made.
Thank you.
Any final questions? Good. Then thank you.